everyone, welcome to Oliveboard. So I am hoping you all are fine and doing well. And also I am visible, my screen is visible and I am audible too. So a very warm welcome to everyone here, and today we are going to start our module D, and in this module we will learn all the MCQs and all the concepts related to these MCQs, which helps in brushing up our concepts. So balance sheet management is the module D. We will discuss all the MCQs related to this module. So let's get started with our first question. You all are welcome here. Join the session. Give like the session if you like, and also give the answers in the comments after see the question. So first question is here. Which one of the following is a source of funds in the balance sheet of banks? In the given four options, which one of the following is a source of funds in the balance sheet of banks? Read the question carefully and give the answer and try to grade yourself. It will help you in where is your strength and where is your weakness related to the subject. If we are talking about first option, that is balances with the RBI. Basically, these are those reserves that banks must hold with the RBI. This includes both the cash reserve ratio, that is CRR, and also the statutory requirements. And banks here must maintain a portion of their deposits with the central bank, that is RBI, which ensure liquidity and stability in the banking system. And RBI regulates this to control the money supply and the inflation. And if we talk about the second option, that is advances made to AAA rated corporate, we can say that when a bank make advances, basically loans or credit to a corporation, or no, AAA rating includes the highest level of creditworthiness. And AAA rating implies that the company is highly unlikely to default on its debt obligations, and lending to such type of companies is considered basically low risk for the banks. Then third option is deposit accepted from the general public. These are that funds that individuals and the businesses deposits into a bank, either in a saving account or current accounts and the fixed deposits. Banks use these deposits to make the loans while offering the interest to depositors in return. There we can say there is an important source for bank funds and funds for the banks. And then fourth option is SLR, compliant investment. SLR, we know that is statutory liquidity ratio. It is the percentage of a bank net demand and time liabilities that must be invested in the specified government securities, bonds and other approved securities. These types of compliant investments are basically those that satisfy the regulatory requirement of keeping a portion of the bank deposits in the fixed deposits, or fixed we can say liquid assets, we also say. And these types of requirement is always mandated by the RBI to ensure that the solvency and the liquidity of the banks. So if we talk about in the given option, which option is correct? So this option is correct, that is the deposits accepted from the general public, because basically banks use these deposits to make loans while offering interest to depositors and return, and they are important source of funds for the banks. Yeah, Mahindra sir, of correct. First option C is correct. Moving to the next question. What is the feature of here notice money market? What is the feature of notice money market? So basically we talk about notice money market. What is the meaning of this? It is basically a segment. It is basically a segment of the Indian money market that is basically where short-term funds are borrowed and lent, but for a period ranging from 2 days to 14 days. It is a key part of the interbank lending market where financial institutions, basically banks, trade liquidity to manage their short-term needs. So in the given option, our first option is correct. In this market, funds are transacted between 2 to 14 days. Understood? Next question. What can be described as ALM? Great Shri Maam. Sir, that is A option is correct. So, third question, sorry. What can be described as ALM, that is asset liability management? So basically, what is the meaning of this ALM? This is a strategic framework which is used by the financial institutions. And which financial institutions such as banks, insurance companies, they are basically manages the balance between assets. Assets are like loans, investments, and the liabilities. Liabilities are like deposits, borrowings, with the goal of minimizing the risk and ensuring liquidity and the profitability. So basically we can say that asset liability management is the act of planning, acquiring, and directing the flow of funds through an organization. So best description of ALM is option B here. Okay, understood? Great. Third, B option is correct. Now, fourth option. How can the net interest margin be understood? How can the net interest margin can be understood? Basically, what is this NIM? In short, we can say it is a key profitability metric for the banks and other type of financial institutions. It represents the difference between whatever the income earned on assets, basically loans and investments, and the interest paid on the liabilities. Liabilities are like deposits, borrowings, and these are expressed as a percentage of the interest earning asset. So we can say that net interest margin can be understood as spread on earnings asset. So here option D is correct. Fourth, option D is correct here. Moving to the next question. Tier 2 capital is restricted to dash of Tier 1 capital. See, if we talk about Tier 1 capital is restricted to 100% of Tier 1 capital. This means the amount of Tier 2 capital that a bank can have is basically capped at an amount equal to its Tier 1 capital. This is in line with the Basel third framework, which sets the guidelines for the capital structure for the banks to ensure financial stability and the risk management. Tier 1 capital is considered like a core capital. Core capital such as equity and retained earnings, we can say, and tier 2 capital includes some type of supplementary capital and subordinated debt and hybrid instruments. These both capitals, tier 1 capital, tier 2 capital, are the categories of regulatory capital that banks must maintain to ensure that they can absorb the losses and the remain type of solvency. And we can say that here these both are the part of the Basel Accords. And Basel Accords, we know that an international regulatory framework that basically sets the guidelines for the capital adequacy in the banking system to provide the financial stability. Tier 1 is basically core capital. This represents the bank most reliable and permanent source of funding, which is used primarily to absorb the losses without the bank needing to cease the operations. And tier 2 capital is basically a supplementary capital. This is less permanent than tier 1 capital that acts as a supplementary cushion for the banks. Understood? So here the correct option is tier 2 capital is restricted to 100%. Here is the next question. Great. So next question is here, how is any capital requirement arising out of credit and counterparty risk to be met? As I told you about tier 1 and tier 2 capital, and we know that what is the meaning of credit risk here. Credit risk, we know that credit risk refers to that risk that a borrower will fail to repay a loan or any type of and fail in meeting any type of contractual debt obligations. And it is the basically the risk which is faced by the lenders, investors, or the banks in all types of lending and borrowing arrangements, which includes bonds, loans, and credit lines. And if we talk about the counterparty risk, we know that it is a subset of credit risk and refers specifically basically to the risk that the other party in a financial transaction will not fulfill its obligation. But if we talk about how is any capital requirement arising out of credit and counterparty risk to be met, so here we can say option A is correct, tier 1 and tier 2 capital. Moving to the next question. What is the recommended principle for ICAP formulation? What is this ICAP? This is basically internal capital adequacy assessment process. Okay. Now what is this? This is a key component of the Basel second and Basel third frameworks, which require banks to assess and manage their capital adequacy in relation to their risk profiles. This ICAP formulation is a comprehensive process that helps banks to identify, measure, monitor, and managing the basically the material risk and ensures that adequate capital levels are maintained to cover these types of risk. So which of the principle is recommended here? ICAP is always encompassed from wide risk profile. Option C is correct here. What is the scope of disclosure under pillar third? What is the scope of disclosure under pillar third? Basically, if we talk about the pillar third disclosures, these are crucial for maintaining the transparency. Maintaining the transparency basically, and also enables the market participants to assess a bank's risk profile effectively. While individual units may provide information, the primary focus of pillar third is considered here level of the banking group to which the capital adequacy framework is basically applies. Means we can say that this type of approach ensures that stakeholders have a comprehensive understanding of all the bank's overall risk and capital management practices. That is what pillar third disclosure is saying. So here if we talk about in the given four option, the correct answer is pillar 3 applies at the top on consolidated level of the banking group to which the capital adequacy framework is applies. That means option B is correct here. Understood? Moving to the next one, disclosure of capital requirement for credit risk falls under which category? Qualitative disclosure, analytical disclosure, principal disclosure, or quantitative disclosure? Disclosure of capital requirement for credit risk falls under which category? Four options are given here. So if we talk about first what is the meaning of qualitative disclosures, these basically focuses on describing on the bank's policies and the processes and whatever the governance that related to the risk management and capital adequacy. These types of disclosures provide context and basically insight into how a bank will manage a risk and what are the strategies behind to manage the risk. And then we talk about if analytical disclosures, this involves use of metrics, ratios, and other type of analytical tools which helps in assessing and comparing the bank's performance and risk profiles. Then this principal disclosure, this refers to the core information that here banks are required to disclose under pillar third to meet the regulatory requirements. These types of disclosure encompasses aspects and focus and significant risk on capital adequacy. And if we talk about this quantitative disclosure, these basically provides the numerical data and the metrics that basically enables stakeholder to assess the bank's capital adequacy and whatever the risk exposure present in the organization or the institution. These types of disclosures complement the qualitative information and help in analysis of the bank's financial health. But if we talk about disclosure of capital requirement for credit falls under quantitative disclosure category. So option D is correct here. All the four option described here. Now moving to the next question. bank should not charge and take to income account interest on any NPA. What is the exception? NPA is basically non-performing assets, which basically refers to the classification which is used in the bank to denote a loan or advance that is default or arrears, and an asset become non-performing when the borrower fails to make the interest payment or principal repayments for a specified period, typically 90 days. So NPAs are significant concern for the banks, and they can affect the financial health of the institution. So if we talk about banks should not charge and take to income account interest on any NPA. So here is the exception, that is interest on advances against term deposits may be taken to the income account on the due date, provided adequate margin is available in the accounts. This is the only exception here. How is the significance in the erosion of the value of the security reckoned? See, if we talk about erosion is the value of security that basically refers to the decline in the market. And market value, we can say market value of collateral or assets that a lender or financial institution has accepted to secure a loan or credit facility. This concept is particularly important in the context of lending, investment, and risk management, because a decrease in the value of the security can significantly affect the lender's ability to recover the loan amount in the event of default. So basically, when the realizable value of the security is less than 50% of the value assessed by the bank or accepted by the RBI, this is the significance in the erosion in the value of security reckoned. So we can say here option B is correct. What is the provision that to be made as per the rules of a loss asset for 10 lakh? The provision is here 100%. We know that loss assets, these are the non-performing assets where there is no security, where the realizable value of the security is considerably eroded. And for the loss assets, the RBI mandates 100% provision, meaning the entire outstanding amount must be set aside as a provision. So we can say here option D is correct. Understood? Now moving to the next question. How is provisioning ratio defined? See, provisioning ratio. Imagine you are running a bank, okay, and you are given out several loans to different businesses. Some of these loans showing signs of trouble. Companies are struggling to pay back whatever they owe. As a responsible banker, you need to set aside the money to cover the potential losses, which is basically called provisioning. Okay, which is basically called provisioning. But now, to measure how much you are setting aside, you are something called the provisioning ratio. But how you define this ratio? For this, let's say you have 100 crores in NPAs. In NPAs, basically that loans that are not being repaid as expected. Now you have set aside rupees 40 crores to cover the potential losses. The ratio would be the amount you have provisioned divided by the total non-performing assets, which is in this case is 40 crores is divided by 100 crore, giving you a 40% provisioning ratio. So in financial terms, we can say that the provisioning ratio is defined as the ratio of provisioning to a gross non-performing assets. This gives you insight into how much of the troubled loans are covered by the provisions. If the ratio is high, it means the banks has set aside a significant amount to cover the potential losses, which is generally considered a cautious and a prudent approach. So here option A is correct. Ratio of provisioning to gross non performing assets. Understood? Which of the following constitutes as an funding risk? If we talk about the funding risk, this risk basically refers to the potential that an organization, particularly any financial institution such as bank, will unable to access or to secure the necessary funding, basically to meet its financial obligation or operational needs. These risks are arises from the various types of factors, which includes the market conditions, liquidity issues, or the regulatory changes. And if we talk about here, the first option is liabilities in the foreign countries. What is liabilities in the foreign countries? These are basically are the financial obligation that basically an organization has a foreign currency or that are arise from the operations in a foreign country. This can include loans, bonds, or accounts payable in a foreign currency. And if we talk about the severe deterioration in the asset quality, this refers to the significant decline in the value or performance of financial institution assets such as loans or investment. This is often indicated by increase in the non-performing asset. And if we talk about the swaps and options, swaps we know that are the financial derivatives that allow two parties to exchange cash flows and other financial instruments over a specified period. And common type interest include rate swaps and currency swaps. And options we know that these are those contracts that gives the holder the right but not the obligation to buy or sell an underlying asset at a predetermined price with the specified time frame. Okay, and temporary problem in recovery, we can say that this phase typically refers to the short term challenges that an organization faces in recovering its financial performance, cash values, and asset values. So if we talk about which one of the following constitutes an element of funding risk, basically option A is clearly related to this, that is liabilities in the foreign countries. What is the reason for complexity in liquidity management for banks with international presence? What is the reason for the complexity in liquidity management for banks with the international presence? So here we talk about this, the complexity in the liquidity management for the banks with the international presence. It is arises arises primarily due to lots of factors, or we can say various factors, which are associated with the operating in multiple jurisdictions. And in the given options, if we read the options, first option is given, the overseas regulators are no nonsensical with regulatory frameworks can vary significantly across the countries, and that indeed create some types of complexities. So this statement is somewhat vague, and we can't directly address this to the liquidity management aspect. So second is, in the event of disturbance, a bank may not always be able to mobilize domestic liquidity to meet the foreign currency funding requirement. Basically, we can say that this is the key reason for the complexity, because if there is a sudden need for liquidity in foreign currencies, banks may find it challenging to access the sufficient liquidity from their domestic operations. This challenge arises from the currency mismatch and the regulatory restrictions in different jurisdictions. So here we can say that option B is correct. This is the reason for the complexity in the liquidity management for the banks with international presence. Next question is, measuring here and managing funding requirement can be done through two approaches. One is a stock approaches. This approach basically focuses on the amount of funding that basically bank or financial institution needs to maintain its operations at a specific point in time. It looks at the current level of assets and the liabilities, which assessing the liquidity available at that moment. And second approach is here is flow approach. What is this approach? Flow approach, we can say it emphasizes the changes in the funding requirements over the time. It basically analyzes the inflows and outflows of funds, which consider how funding needs may evolve based on different factors such as cash flow projection, loan disbursement, and payment schedules. And this approach is basically dynamic. Which allows organization to anticipate and plan for future funding needs. So this option is correct, that is flow approach. Now, which one of the following is ratio should be higher for the better liquidity management? So if we talk about the liquidity management, basically this is the process where the financial institutions and businesses ensures that they have sufficient liquid assets to meet their short-term obligations while maximizing returns on their investments. It is basically a critical aspect of financial management that involves monitoring, forecasting, and also managing the cash flows as well as maintaining an appropriate balance between liquid and illiquid assets. So here we can say that ratio of core deposits to total assets is fine for this question. Now, moving to the next question, here we have to talk about the gap or mismatch risk. What is the meaning of gap or mismatch risk? Gap and mismatch risk. See, if we talk about gap or mismatch risk, this refers to the potential for financial loss arising from the differences in the timing of cash flows which is related to the assets and the liabilities. This risk is particularly relevant in the context of interest rate risk management, and as it can significantly affect an organization's profitability and the liquidity. So if we talk about the correct option, a gap or mismatch risk arises from the holding assets and the liabilities with different principal amounts, maturity dates, and repricing dates, thereby creating exposure to changes in the level of interest rate. So the option A is correct here. That is the meaning of gap risk or mismatch risk. Basis risk. What is basis risk? This is type of a financial risk that arises from the imperfect correlation between the price of a hedging instrument and the price of the asset being hedged, and this discrepancy can lead to the potential losses when the hedging strategy does not perform as expected. So basis risk is the risk that the interest rate of different assets and liabilities may change in different magnitudes. Next question, what is embedded option risk? Embedded option risk. This risk is associated with the presence of embedded options in the financial instruments such as bonds, loans, or the derivatives. And embedded options gives the holder certain rights, such as basically we can say the ability to convert, redeem, and extend the terms of the contract under some type of specified conditions. And this basically can significantly impact the cash flows and the valuation of the instrument. And if we talk about here, the correct answer is the risk of premature withdrawal of deposit and prepayment of advances is called embedded option risk. Now, what is the crucial assumption in bond pricing formula? Bond pricing, basically we can say that bond pricing is always dependent on financial strength of the buyer is the first option here. We can say while the credit worthiness of the bond issuer, which is not the buyer, does affect bond pricing, that is not primarily assumption of the bond pricing formula itself. We can say here whatever all the coupon payments, this is the current exemption, because the bond pricing formula assumes that all coupon payments received are reinvested at the same amount as the bonds YTM. This assumption is essential for calculating the present value of future cash flows accurately, and also it impacts the total return an investor will receive from the bond. So basically option D is correct here. While expected losses are covered by specific reserves and provisions, how are unexpected losses handled? Unexpected losses. What does that mean of unexpected losses here? This is in the context of banking and credit risk management. If we see, this is the loss that is refers to the end, basically, which exceeds the expected losses due to some type of unforeseen circumstances. And if we talk about here the unexpected losses, it is a measure of the amount of income capital which is required to support the bank's financial risk. So here we can say, while expected losses are covered by specific reserves and provisions, unexpected losses handled through capital allocation, which is based on the confidence level, time horizon, diversification and the correlation here. So that the option B is correct. Now, the pricing of product should provide a buffer against expected losses. What do unexpected losses indicate? See, unexpected losses basically is a measure of the amount of economic capital that is required to support the bank's financial needs. So if we talk about the option A and B, these are incorrect. The correct option is option C. This is the measure of the amount of economic capital which is required to support the bank's financial needs. And how is risk adjusted performance defined? If we talk about this risk adjusted performance, this is the measure which is used to evaluate the return on an investment or the performance of an asset while considering the risk associated with it. And the correct definition from the given option is the profit for each unit of risk capital, because this option is basically here the correct, because this is the correct definition. Why? Because the risk adjusted performance measures how much profit is generated from each unit of risk taken, and it also provides a clearer picture of how effectively a firm is managing its capital in relation to the risk it assumes, and also allows better comparisons across different types of investments or the portfolios. So here the option D is correct. Profit for each unit of risk capital. So this is it for the today. We completed all the MCQs related to the module D. I hope that you enjoyed this session, and this session will help you in any aspect. So if you like this session, kindly give the like, and also we will meet in new sessions with different types of topic which are helpful for our examination. So thank you so much for giving your time, and also if you like, so kindly give the like and also subscribe to this channel. Thank you so much everyone. We will meet again with a new session. Till then, take care, all the best, and yes, have a good day all. Thank you everyone.